All right. So next Tuesday, we're playing Jeopardy, and I'll let you know which groups are going to be playing pretty much this weekend. Again, these are completely randomly selected. I have, oh, over time, if you competed today, I can guarantee that you won't be competing next time. Of course, my Monday, Wednesday, 9:05 class, I have only 4 groups, so everybody's going to compete every day. But in this case, you'll be competing basically every 2 Jeopardies on an expected basis. Let's continue. We kind of got started on the income statement. We said what it was, and we looked at the structure, how to recognize the revenue. Sales process is complete. You can ascertain value of the sales. You can ascertain that that amount is going to be received, and goods and services are shipped. We looked at the cost of goods sold. It's calculated using the matching principles. You basically match expenses to the production of that. Not all expenses are in cost of goods sold. For example, certain expenses like operating expenses, the rent you pay for your headquarters, the salaries you pay people who work in the headquarters, because whether or not you sell 100 computers or 100,000 computers, you're going to have to pay that guy in the mailroom, right? That has nothing to do with production. Just to give you an idea, I already have Starbucks over here. Let's look at their income statement. Uh, this is quarterly. Let's do it annual. Actually, this is annual. Yeah. But that thing called TTM is short for trailing 12 months. Over the last 12 months, Starbucks sold $36.5 billion worth of stuff, but it cost them before overhead, I'm going to call it, about 26 or so, which means their gross profit is a little bit over 10 billion. For every $100 that comes in, Starbucks keeps about $27 before worrying about other costs. It's no longer public, but in the old days, when you looked at this at Panera, that number was close to 60. Why? Because Panera does more than coffee. They do sandwiches and stuff. And trust me, those sandwiches cost almost nothing to produce. You can also look at those gross margins over time. For example, back in 2021, they were keeping about 29 cents. So things are, relatively speaking, going down for Starbucks. That may be, among others, one reason they recently fired their CEO and they get a new one. Once you get the operating expenses, let's kind of look at them. You have the so-called selling, general, and administrative expenses. You know, advertising is among them, among the selling costs. General and administrative are essentially overhead. And you also have depreciation and amortization in there. And obviously, you have always the others at this level of disaggregation. And once you deduct operating expenses from the gross profit, you get the operating income. Sometimes we call that uh, earnings before interest and taxes. AKA short EBIT. Remember, we tell stories with financial statements. This basically says, before I have to worry about how much does it cost for this firm to finance its debt and taxes, are they making money? If they're not making money, if a company is losing money, it could be a lot of different reasons. They may be paying high taxes. They may have high interest costs. They may have, they're not making much money on gross profit, or they have too much overhead. For example, what's the operating margin, which is EBIT divided by revenue? Let's look at what that was for Starbucks. 54.90 divided by 36,475. So before we have to worry about interest payments and taxes, Starbucks keeps about $15 out of every $100 worth of cappuccino they sell. Then, of course, we worry about uh, net interest expense or net interest income. If it is negative, remember, negative income is expense. They obviously keep some cash around, so they got about 126 million in interest income, but they also have debt that has interest costs. Net net, they're paying about 439. You always have the other income expense, and the which gives you so earnings before tax, EBIT minus net interest expense minus other expenses. Then, of course, you have tax, and we're gonna abbreviate earnings before tax as EBT, net income, short NI, EBT minus taxes, or you can think of this EBT times 1 minus tax rate. There is no single tax rate, but just to make things simple. Unlike personal income taxes, there isn't too much graduation in corporate income taxes. For example, uh, for your personal income tax, if you're filing single, I think up to 13,000, you pay no taxes. After that, the next 10,000 or so, you pay 10%. Then there's another bracket on there, you pay 12. Then you go to 20, 22, so on and so forth. There is some graduation in corporate income tax, but not much. And currently, most corporations, at least on paper, pay about 22% federal corporate income tax. Depending upon the state you're in, you may have state taxes as well. In California, that would be 10%. In Tennessee, that would be zero. New Hampshire, that would be zero. Texas, it would be zero. And there may even be some local income taxes. For example, If you're a company headquartered in New York City, you're going to pay city taxes. That's why there aren't that many companies that are headquartered in New York City. Corporations actually do a lot of arbitrage with respect to tax. For example, let's look at Starbucks. Their pre-tax income or earnings before tax is 5,369. They paid 1,297. So their net tax rate, this is total, federal, local, and state, 24%. You're thinking, that sounds about right. Let me show you another company. Apple, let me see. They pay 18,917 divided by 120,873. Their effective tax rate is 15.6. And I can almost bet that federal is pretty close to zero on that. And state taxes are probably a lot higher because under federal law, if a company makes money outside of the United States, that money is not subject to federal taxation until it is brought back to US. Guess where most of the sales are booked? Most of Apple sales are booked. They're booked in Ireland.